Hello everyone, Bryan here with your Las Vegas market update video for August. Just like I predicted the housing inventory shortage on October 27th of 2011, today I'm going to make another bold prediction. When I told you 2 years ago that we would run out of inventory in 6 months and that prices would jump, most people just thought I was crazy. Well, today I'm going to try and explain to you why the market is heading for a drastic downturn. While the media and most people are 6 months behind the curve, I pride myself on looking forward 6 months to provide my clients with a substantial advantage in the market. Now, before we get to the main story, first let's cover our normal monthly statistics as quickly as possible. As you know, the first topic we cover is inventory. If you've been watching for a while, you know that typically I throw up the last 4 weeks of inventory levels. Today, I'm going to show you what's happened since April instead. Take a good look now for yourself. In the beginning of April, we had around 3,000 homes. With the exception of 1 week in May, we've increased every single week. As of today's filming, we are sitting at 4,790 available homes. Quick math, that's a 60% increase in only 4 months. Like I said in last month's video, we could have 6,000 homes come Halloween, which would effectively double our inventory in only 6 months. It certainly looks like I'll be right on that one now. Next is a quick breakdown of the current inventory. As you can see now on the screen, only 13% of the inventory are short sales, while 8% of the market are foreclosures. That leaves 79% of the homes as traditional sales. The key number in this mix here is that there are only 266 foreclosures on the market. Just remember that part for later, okay? I'm going to brush over the notice of defaults this month because we've got more important issues to discuss, to be quite honest. Just know that the NODs finally started to pick up steam around mid-month and ended up around 400. Next month, I'm expecting it to double to about 800. Now it's time for a segment I'm going to call the Tides of Change. I'm calling it that because it sounds a bit more diplomatic than the housing bubble part 2. To be clear here, I'm not trying to strike fear in people or predict a major housing crash. I'm simply attempting to illustrate why the market is heading downward and why price adjustments are very likely to occur in the near future. Now, while most people are still caught up in the idea that the Las Vegas market is booming, the fact of the matter is that we peaked back in April and have subsequently been sitting on a plateau since then. Now, we're about to see a downward trend in values moving forward. The reason is this: inventory is expanding at a rapid pace, but overall sales are flat. So essentially, more people are wanting to sell than people are willing to buy. Investors are walking away from buying in Vegas because the relationship between home values and rents just don't make sense anymore. You see, the investors cannibalize themselves. Too many investors bought properties instead of owner-occupants. Now, they are all fighting with each other for tenants. Colony Capital, which is the second largest hedge fund, is currently operating at a dismal 50% occupancy rate. Simply put, the cash buyers that were driving this market just drove elsewhere. This leaves room, however, for real people who are disenfranchised. Well, to finally purchase, that is. But recently, FHA insurance and interest rates have substantially increased and crushed affordability among the most sensitive of buyers. So let's be honest with ourselves for a second too. The Las Vegas job market isn't fantastic. Unemployment is above the national level here. So that's not working for us. Then we have the elephant in the room. we never solved the actual problem. We have reported 44,000 homes that are sitting vacant in Clark County and 80,000 properties that are delinquent on their mortgage. So we've got a supply that almost doubled in 6 months, a demand that is diminishing, and the purchasing power of that demand is diminishing as well. So what happens when the foreclosures do start coming back? You can't keep those foreclosures away forever. And here's the big problem. We already know that 80,000 people are not paying their mortgage. Since the banks aren't knocking on their door anymore, there's no incentive for them to put their home on the market as a short sale, right? But what happens when the banks do start knocking and foreclosing again? All those people who haven't paid their mortgage in 3 years will suddenly be forced to put their homes on the market rather than simply be foreclosed on. Nobody has even talked about that issue or component. Whatever our inventory levels are at that point, we could easily double that number in a very short span because of the short sales and foreclosures. Come on, we all know people who aren't paying their mortgage and have no intention of selling anytime soon either. But nothing lasts forever. Originally, I thought that we wouldn't have to worry about the market until the banks started foreclosing again. Now that the market is correcting itself on its own, we may see trouble before the foreclosures actually arrive. So my fear is this. Once the inventory doubles in a couple of months, the media and public will start picking up on this. The housing bubble fear will begin to take form at the real estate market's weakest time, the holiday season. As buyers watch the inventory increase and hear these grumblings of a bubble forming, some buyers will simply elect to wait out a year and rent. Now, once people start sitting out a year, it becomes a self-fulfilling prophecy. If demand shrinks and supply remains consistent, or dare I say, increases, then economics dictate a reduction in prices. Folks, we manipulated a market and falsely drove the prices up. Anytime you manipulate an economic market, there has to be a correction. When you throw in the massive amounts of foreclosures that we're just sitting on, it simply doesn't bode well for the future. As a result, I'm officially calling an end to the home price appreciation here. In the next few months, you're going to see motivated sellers forced to lower their prices below comps for the first time in years. Buyers are already becoming more patient, and their confidence is increasing as they watch these homes just stack up. Now, in West Summerlin, the current inventory has exploded 260% in only 3 months. Why? Because this was an area that saw the highest amount of appreciation and holds the highest median price. Now that the panic has calmed down, rational buyers are no longer willing to pay these escalated home values. As a result, homes are sitting and sellers are getting nervous. This micro example in Summerlin serves as foreshadowing into what I see down the road for the greater Las Vegas market. So quickly, let's wrap this up. Inventory levels are expanding at a rapid pace. Traditional sales are still dominating the market. The notice of defaults are still quite low, but recovering. And home price appreciation has simply plateaued. So if you're looking to sell your home, you had better put it on the market ASAP and take whatever you can get today, since you won't be able to get more tomorrow. Even if you have to sell for less than you hoped for, be grateful, because it's more than what it'll be worth next year, I'm telling you. If you're a buyer, I would say be cautiously realistic about what you're purchasing. The low end of the market is stable in the immediate future, since there are still so many buyers looking to own that have been sidelined for the past few years. But for properties over $300,000 to $800,000, I think you're going to see some serious price resistance moving forward. As always, thank you for watching. Please click here to subscribe, and please feel free to contact me directly with any questions or concerns you have regarding the Las Vegas real estate market.